California property taxes are pretty straightforward. You own property, you get to pay taxes on it. Not hard to understand. I covered that subject in another video, which you can find in the video description below. But California supplement taxes, although it is part of the general property tax discussion, it is a little bit more complicated and harder to understand. This is Juliana too, and I'd like to take you on this ride. Be sure you stop and get off for a few minutes if you are getting queasy or confused. So let's go to it. First, my disclaimer. The information contained in this video is only intended to provide a guide in the various California-only transactions to which the information is applicable. No representation is made as to the legal validity of the information or the adequacy of it in any specific transaction. The information contained should only be used after consultation with your legal and financial counsel. We get calls on supplement taxes all the time from our clients, and that's why I decided I needed to cover this topic. But in order to understand the why and how of supplemental taxes, we need to understand regular taxes first. So let's go to the regular taxes first as a starting point. All privately owned properties in California have regular taxes. We call them secured taxes. The assessment is on the owner of the property on January 1, and the value of the assessment is based on the value of the property on January 1. So January 1 is an important date because that's who owns the property and what his ownership, what his value is going to be assessed at that year. The assessment is 1% of the value plus any additional city, county, school bonds, improvements that are voted in. We usually use 0.25 to 0.50% as the value. It covers the fiscal period from July 1 to June 30th. This is very important. This fiscal period is from July 1 to June 30th. And the property taxes come out October of each year. It's payable in 2 installments, November 1 and February 1, and it becomes delinquent with penalties if not paid by December 10 and April 10. Now, under Proposition 13, the assessor's office is mandated to reassess the taxes to a new value once the property changes ownership. So what would be the tax amount under the new value? For example, let's have a new value of $700,000. That times 1.25 means that their property taxes are going to be $8,750 per year. If the regular tax bill is already issued, it has to be paid. You cannot escape it even though the property was transferred midway through the year. The regular tax bill still has to be paid. However, added on to that regular tax bill will be the prorated portion of the new tax amount from the day that the escrow closes to the end of the tax fiscal year of June 30th. So let's continue with our example of the new value and $700,000 and decide that the escrow closed on January 27. So the new value, 700,000 times 1.25, we said, is $8,750 per year. The new tax amount of $8,750 is from January 27 to, which is the closing date, to June 30th. That is a $24 per day tax amount. $8,750 divided by 365 is $24 per day. For that tax period of 127 to 630, it's 154 days. So 24 times 154, the new tax value would be $3,696. Got it? Let's go on. If the old tax bill is $3,750 per year, Then if you divide that by 365, that tax is $10 per day. And at 154 days, you've got 10 times 154. That's 1,540. So for the 154 days under the old tax bill, you would get 1,540. So the taxes from the closing would be on the new rate, the 3,696. You subtract the old rate of 1,540. So it equals to 2,156 because you don't want to double pay during that period. So the total taxes to be paid would be the original old bill of 3,750 plus the new rate from January 27 of 2,156. So the total would be 7,446 as an estimate. And the reason I say estimate is because the percentage of 1.25 that I use could be a little more or a little less from what the auditor would use. This example is given so that you have an idea on how the new taxes are going to be prorated and paid by the buyer. Let me point out some facts regarding supplemental taxes. They can also be paid in 2 installments, and the bill will tell you when they have to be paid. Once the first year of that supplement taxes are paid, the regular tax bill for the next year will then be recalculated, and it will be based on the new purchase price value. However, if the closing of this transaction is near about June 30th of the year, which is the end of the fiscal tax year, you may actually get 2 supplement bills, one for the year ending June 30th and one for the new fiscal year that starts July 1. If you have the lender impounding for property taxes in your loan program, the lender will pay the regular taxes for that first year. They will not pay the supplement taxes. That will have to be paid by the borrower. But this is only in the first year. Once the regular tax bill incorporates the new value, then you won't have to worry about it. The lender will pay the property taxes correctly. Here's a couple of questions and answers. Are supplement taxes prorated? Answer number 1 is no. Supplement taxes are issued because of the change of ownership to the new buyer. So the seller does not owe any of it. It's all the buyer that is responsible. Answer number 2 is yes. It is prorated if the supplement taxes belong to the seller's change of ownership and are for the same tax year in the transaction. So you're saying, what? Okay, so let me give you an example. The tax year starts July 1, and the seller bought the property in November. And then 4 months later, he sold it, and the escrow closed in April. So the tax bill for the regular tax bill came out in October, but there's going to be a supplement for the seller's purchase in November. Right? So you have to add these 2 tax bills together. And that tax bill then will have to be prorated. It is very, very confusing because the seller purchased it and flipped it right in the same tax year. So the question to ask when you get something like a supplement bill and you're wondering whether it should be prorated the question is, why was it issued? And for which fiscal year was it issued for? Okay, another question is, what if there's supposed to be this tax bill, the supplement bill, because the seller bought the property, but it doesn't show when the new buyer closes the escrow? Then you can't prorate it, right? Yes, the escrow agent can only pay and prorate based on tax bills that have already been issued by the collector's office. We do not guesstimate the future regular or supplement taxes if it hasn't already been issued. So The buyer may, if they encounter this scenario, if they think this is going to happen, they may want to discuss this with the seller after the closing, or they can talk to the escrow agent and see what can be done. So what if the buyer finally received that supplement bill after closing? Well, the answer is, if this is a supplement that is for the same tax year that closed the escrow, we would recommend that the buyer pay it, because the tax bills are scheduled on the property, not on the seller. They are secured on the property. And if the buyer is now the owner of that property, it behooves him to make sure that all the taxes are paid. Of course, if the buyer wants to try and go back to the seller and try to get some money from him, that would be, of course, his prerogative to do so. What if the buyer received a supplement bill with a seller's name on it, but it's for a previous tax year? Well, if that's the case, then they need to contact the tax collector's office, let them know that this bill came in for a time in which he didn't own the property, and the tax collector will need to put it on the unsecured tax roll and take it off the secured tax roll. This is pretty much an escape tax bill. What if I'm only buying part of the property? Will I get a supplement bill on that part? The answer is yes. Yeah. The property changed ownership, even if it was only a part of it, so it gets reassessed. So here's how it works. The assessor's office will reassess the value of just that percentage point that was purchased. They will advise the auditor controller's office so that the controller's office can determine the amount of tax that applies to that percentage point portion. And then, of course, they will let the treasurer and tax collector know so that they can issue the bill. And as you purchased that percentage portion may not be happy with that reassessment, then you can go to the assessments appeal board to appeal that decision that they made. While most California counties have the same setup, some may incorporate these 4 tax departments differently. Some would combine it, or some might go ahead and combine them with other departments. But there's usually 4 departments that deal with taxes in California. The assessor's office assesses and determines the value of the property. The auditor controller's office, which receives the assessment information and then applies the correct tax to that parcel, depending on whether they have other school bonds and improvements and so forth. Those are added on. And then they will let the treasurer and tax collector know, who will issue the bill and collect the payment. And of course, if you don't like what they have assessed your property at, you can always go to the Assessment Appeals Board. I know that this has been a very dry and hard to understand subject, but it had to be said. It had to be taught because we deal with property taxes all the time. If you own property, you will deal with taxes. Today, my t-shirt is vintage. Yes, because I am vintage, and I am proud to proclaim it. I am an old blend, blended to perfection, and I have all my original parts. There are other articles in my video description below, which links to part of this topic that I talked about today. I hope the information I provided is going to be useful to you. Be sure you click the link and subscribe icons. This is Juliana 2. Thank you for watching, and I shall see you in my next video.